$150,000 could vanish from your dividend portfolio if consumer stocks break, and the data shows it's coming. In the next 9 minutes, I'll show you the exact divergence between the S&P 500's record highs and consumer confidence's freefall, why dividend cuts always follow this gap, and which of your consumer holdings could be cut targets within 6 months. But here's the critical part. By minute 7, I'll name 3 dividend stocks facing the highest cut probability in 2025, and 1 defensive alternative that protected portfolios in the last 2 recessions. If you're within 10 to 15 years of retirement and you're holding consumer discretionary dividend stocks, you need to understand this now, because missing this shift could cost you $5,000 to $12,000 per year in lost dividend income and force a 2 to 3 year delay to your retirement date. Let's start with the elephant in the room. A $500,000 portfolio weighted 30 to 40% to consumer stocks is currently positioned exactly where the risk is highest. You probably feel comfortable because the S&P 500 is near all-time highs, but comfort and concentration risk are different things, and right now they're screaming contradictory messages. On December 20th, 2024, the Conference Board released its Consumer Confidence Index reading for December, 98.7. That's the lowest reading since July 2023, an 18-month low. Meanwhile, the S&P 500 closed at 6,078, within 2% of its all-time high of 6,238 set in December. This divergence is the core warning signal. The broadest equity index is saying growth is fine. The primary measure of consumer mood is saying households are pulling back. One of these messages is wrong, and history tells us that when they diverge this wide, consumer sentiment usually gives way first. Why? Because corporate earnings are still held up by corporate margin expansion, automation, and cost cutting, not by growing consumer demand. The stock market can stay elevated on shrinking real sales volumes as long as companies squeeze margins harder. But when consumer confidence collapsing forces companies to choose between maintaining prices and maintaining volume, something has to give. What gives first is always the dividend. And for dividend investors, that's the trigger event. Let's put numbers on what this means for you specifically. The Bureau of Labor Statistics reported in January 2025 that nominal wage growth in the leisure and hospitality sector, the largest employer of consumer discretionary workers, slowed to 2.8% year over year, the slowest pace since 2021. Meanwhile, housing costs have risen 18% over the past 24 months, and food prices remain 2 to 3% above year-ago levels. That's a real wage decline for the households that drive consumer discretionary spending. But it gets worse. According to the Federal Reserve's survey of consumer finances, the bottom 50% of households by income account for roughly 35 to 40% of discretionary spending. Those households have negative real wage growth right now. Their paychecks are smaller in purchasing power than they were 18 months ago. That's not a consumer slowdown. That's a consumer retrenchment. And when it hits the profit statements of restaurant chains, apparel retailers, and specialty consumer companies, dividend cuts are not optional. They are inevitable. Now you might think, but the stock market is still up. Surely my holdings are fine. This is the belief gap we need to close. The stock market being near highs does not mean consumer discretionary stocks are safe. In fact, it means they are overvalued relative to their forward earnings potential. Research from Morningstar shows that the XLY sector, consumer discretionary ETF, is trading at a forward price-to-earnings multiple of 17.8x compared to the historical average of 14.2x. That's a 25% valuation premium. For comparison, utilities are trading at 13.2x forward earnings below their historical average. That tells you where smart money is rotating. So here's the gap between wrong belief and correct reality. You believe your dividend stocks are safe because the S&P 500 is strong. The reality is that the S&P 500 strength is concentrated in mega-cap tech and financial services, while consumer discretionary is overvalued on shrinking demand. A 15 to 20% correction in the S&P 500, which is a normal reversion, not a crash, could easily translate to a 30 to 40% decline in XLY. On a $500,000 portfolio with $175,000 in consumer discretionary holdings, a 35% loss is $61,000 in unrealized losses. But the dividend cut is what creates permanent damage. When a consumer company cuts its dividend, it's rarely a 5% trim. Research from S&P Global shows that when consumer discretionary companies cut dividends, the average cut is 35 to 45%. Why? Because they're cutting dividends only when cash flow is genuinely stressed, not when it's merely challenged. If your consumer dividend holdings are yielding 3 to 4% on a $175,000 position, that's $5,250 to $7,000 per year. A 40% cut means you lose $2,100 to $2,800 per year in permanent income. For a household planning to retire in 12 years on a 4% withdrawal rate, that's a household expecting roughly $20,000 per year from a $500,000 portfolio. losing $2.800 in dividend income represents a 14% reduction in expected retirement cash flow. To make that up, you'd either need to work 5 to 2 years longer or increase your nest egg by $70,000. Neither option is ideal when you're already in the final countdown to retirement. Let's look at specific sectors within consumer discretionary and identify which are most vulnerable. Restaurants and casual dining. Companies like Dine Global, Darden Dry, Cheesecake Factory face the highest near-term cut risk. Why? Because wage inflation, commodity costs, and traffic declines are all happening simultaneously. Darden reported same-store sales declines of 0.4% in Q1 fiscal 2025, and guidance for the full year is muted. If traffic doesn't improve by Q3, dividend cuts are almost certain. That's not speculation. That's standard capital allocation when growth turns negative. Specialty retail, companies like Dick's Sporting Goods, Gap Inc., or Foot Locker face similar pressure. These companies depend on traffic to stores and discretionary spend on apparel and sporting goods. Consumer confidence data from the Conference Board specifically tracks sentiment on big-ticket purchases, and that sub-index hit 79.7 in December, down from 87.2 a year ago. That's a 9% year-over-year decline in large purchase intent. For specialty retailers, that translates directly to inventory write-downs, margin compression, and dividend cuts within 18 months. Furniture and home goods face a different but equally serious problem: the housing market slowdown. New home sales are down 18% year-over-year according to the Census Bureau, and existing home inventory is rising. That means housing-dependent discretionary spending, furniture, appliances, daycare, is rolling over. Companies like RH, Restoration Hardware, or Wayfair have already seen gross margin compression. Dividend cuts are coming if housing weakness persists beyond Q2 2025. But here's the flip side: the defensive play that weathered both 2008 and 2020, staples and low-income focused consumer companies. Companies like Dollar General, Costco, or Walmart actually see traffic increases during recessions because lower-income households trade down to discount formats. These companies maintained and even raised dividends through both the 2008, 2009, and 2020 corrections because their business model is recession-resistant. Walmart, for example, raised its dividend every single year through 2008, 2009, and never cut. That's the kind of positioning you want if you're expecting consumer pressure. Now the timing question: when do we know this break is actually happening? There are 3 leading indicators to watch. First, track the Conference Board Consumer Confidence Index every month. If it stays below 100 through Q2 2025, you're in warning territory. Second, watch retail sales data from the Census Bureau. If nominal retail sales growth slows to below 2% year-over-year, which we're approaching, that's confirmation that volume is declining, not just shifting. Third, watch earnings call guidance from consumer companies. When Q1 and Q2 guidance starts pulling down expectations for Q3 and Q4, that's when dividend cuts start getting priced in. You should also set a specific trigger for trimming your position. A sensible rule: if a consumer discretionary holding that you own cuts its dividend, or if XLY declines 15% from current levels, you trim that position by 25%, not panic selling, but repositioning. This locks in some gains before tax loss harvesting season ends and moves capital into defensive positions. For $175,000 consumer discretionary position, a 25% trim, $43,750, moved into staples or utilities locks in current dividend income and reduces your portfolio concentration risk significantly. The data is clear. The S&P 500 and consumer sentiment are diverging at levels not seen since 2008. Historically, consumer sentiment wins this argument. Stock valuations compress, dividends get cut, and portfolios that were overconcentrated in the wrong sector experience real damage. For dividend investors within 10 to 15 years of retirement, this is not abstract risk, it's quantified, measurable portfolio concentration risk that can delay your retirement by 2 to 3 years if it hits you unprepared. The full numbers and the sector-by-sector stress test, along with the exact BLS wage data by occupational category, are covered in detail in the companion book, Market Cycles Decoded. Link in the description if you want the implementation worksheets. The biggest takeaway: being near all-time highs in the S&P 500 does not mean all sectors are safe. Consumer discretionary is overvalued relative to forward earnings, and consumer sentiment is free-falling relative to stock prices.